Coming up on the Mouth Check, the Strait of Hormuz is closed. Port of Dammam is closed.
There's definitely product that's stuck, can't get to its destination.
Welcome to the Mouth Check from Ted Jacoby III, your complete guide to dairy markets, from the milking parlor to the supermarket shelf. I'm Ted Jacoby. Let's dive in. Today we're going to talk about what's going on in the dairy markets, specifically global trade. We're recording this on March 6th, 2026, and 7 days ago the U.S. bombed Iran. As we speak, the Strait of Hormuz is closed. Port of Dammam is closed, and trade flows are getting rearranged as we speak. Today with me, we have Joe Maxner, head of our Butter Trading Book. We have Josh White, we have Diego Carvalho, and we have Mike Brown. And we thought it would be appropriate to discuss what's going on in the Middle East, specifically how it's affecting the dairy industry and what its short-term and long-term effects will be on dairy demand. We're going to start with Joe. Joe, what are you hearing out there right now?
There's definitely product that's stuck, can't get to its destination, both going into Port of Dammam and other Middle Eastern ports for that matter. With butter's moves over the past year, the Middle East market had been probably the largest growth opportunity for us in global exports for butter. Fortunately, this all happened after the rush for Ramadan to get everything in. So I would say that it's not as bad as it could be right now, but there is certainly product that's stuck on the water, looking for alternative options to get to land. And there's quite a bit of product that still is waiting to leave the U.S. that we're not quite sure if and when it will actually leave. A lot of it's still up in the air. Nobody really knows what to do yet. I think it's still too early to tell. Nothing's been canceled per se, but the longer that this drags on, we're certainly going to have some effects from it.
There's a lot of talk that maybe this war is going to be a 5 to 6 week war. If the Strait of Hormuz is closed for 5 to 6 weeks, as is the Port of Dammam, is that enough to cancel orders? Is that too long?
I would say it should probably cancel some orders. I wouldn't say it would cancel everything, but they're going to have to get product at some point from somewhere. They can't completely stop. People are going to have to eat. Production will still have to continue, and they're going to have to source product from somebody. If we can't get it there, they'll find it from somewhere else.
I'm hearing that one of the things that they're exploring is shipping into Jeddah, which if you look at a map of the Middle East, Dammam is in the Persian Gulf. On one side of the peninsula, Jeddah is basically on the exact opposite side of the peninsula on the Red Sea. So they're talking about shipping into Jeddah and then shipping it across the land to where it might need to go. The first thing that occurs to me is Dammam, I believe, is a bigger port than Jeddah. And so if you take all those container ships going into Dammam and send them to Jeddah instead, there's not going to be enough room to unload them all. And so at the very least, the traffic's going to be pretty horrific. Are you guys hearing people working on that too?
Yes, they're looking at alternate ports of entry and moving the product around. Jeddah is one, Casablanca is one, going into Egypt is one. There are options. All of them are more expensive, and it's just going to depend on how desperate the end user is to get the product.
We've got some experience dealing with trade disruptions over the past decade, and we tend to see the playbook similarly each time. And then when we talk about what's specifically happening in our markets now, I think we can watch for some warning signs. Number one is in these type of situations, we start worrying about trade flows, energy, freight, congestion, those type of things, all impacting markets and trade. Additionally, when we think about this conflict, there's maybe 3 different scenarios to talk about. It's very intense right now. Does that intensity continue for a very long time? What does that mean for our trade? It's very intense right now, but after 4 to 6 weeks, maybe it continues on, but it's more stable or consistent, and the world learns how to trade around it. And then the third one is the one you outlined earlier, which I think is a bit optimistic. Usually these things don't just go away that quickly, is that it's over in a short amount of time. That's the easiest one for us to project. That just creates a short-term concentration, pent-up demand, pent-up shipments, and we just got to work our way through that bubble. I think the middle one's more likely, not because I'm an expert on these things, but we've seen what happened in different conflicts and different situations. The middle one being it's intense for a bit, then it becomes more consistent and normalized, and we just learn how to work around it. What does that mean? And to me, that redirects trade flows. For instance, the U.S. has been very competitive in the Middle East for butter and cheese. It's not the first time we've been competitive. We were competitive 15 years ago or so at a pretty good rate where we were a net exporter of butter fat. Cheese, I think we've been fairly consistent throughout, but it takes time to get there. Our biggest obstacle in doing business with that market versus Europe as a competitor is the transit time. We inflate the freight rates, we increase transit time. There's concern of access to supply because of turbulence or stability. Our price could be fine and we could still miss some business because you have to buy now, or you got to get product in now, or you just don't have time to wait 6 weeks from order at minimum, probably more like a quarter oftentimes to get the product. That's maybe our biggest obstacle right now is redirected trade lanes, not price.
All of these trade disruptions created opportunity elsewhere. If our price comes off, as it has, butter shot up earlier this week, it's come back off here at the end of the week. It's created opportunity for trade into other export markets. Where one door closes, another opens.
How do you think those trade flows change? What comes, what goes? What are the changes that you think will happen? Let's assume that the Persian Gulf is off limits for 2 or 3 months. What does that mean for dairy?
Lost demand, if it's that long. That's lost demand. Now, if we assume that we're able to redirect product to maintain the same demand, you're going to have trade lanes shift, right? What are the options?
Let's articulate this a little bit more for our listeners. When we're talking about trade lane shifting, right now there's product on the water trying to head there that can't. What's going to happen to those ships? That's one. 2, there's product that was sitting in the port about ready to ship. I think there were a lot of calls this week. I think we know of quite a few calls this week where they basically said, let's sit on it. Let's wait for this all to calm down before we actually ship it. And 3, there's product that maybe was scheduled to ship in a month or 2. I think it's fair to say people probably have to figure out immediately what are they going to do with the product that's on the water right now. And I think the other 2, they may be able to give it a little bit of time, decide whether or not they're going to cancel any orders and redirect it. Diego, the product that's on the water right now, what do you expect happens to it?
That I've been internally debating this for a while, and even with the team. I think a few things are happening, but I don't know which one has a bigger magnitude. Supply chains used to be very thin for skim milk powder for past year or 2 years. They are going to have to build more inventory for those supply chains because product might take 60 days instead of 30 days to ship it. Product is going to get stuck at the port of entry, port of shipment, e-transit, etc. So I think that bumps up demand artificially. Yeah. But there's more product that's going to be stuck in the supply chain. That's the first thing that comes to mind short term if this doesn't continue to escalate. But if things continue to escalate and 3 weeks from now or a month from now, we're still not being able to ship product to those destinations, product is going to start backing up at ports of loading, right? So we're going to start hearing from the California manufacturers that they have 100, 200 loads at port and that prospects are not great for shipping and that we should find new homes for that, right? I think if this gets solved in the short term, it's positive for demand. It's bullish market, but if it goes more long term, you start killing demand and you start needing to find homes for additional product. But I know that everybody, at least on our team, has different takes on the whole situation.
I would agree with that. I tend to lean to the side that politically, the Trump administration can't afford for this to go on too long. And the longer the strait is closed, the more political pressure they're going to have to resolve things. It's realistic to consider that there's a possibility that this thing goes on for a really long time, and that strait is closed for a really long time.
The second topic that I think we should talk a little bit about is what is the psychological implication that this has on buyers? For example, Chinese buyers who depend on products that go through that canal. That's why I lean towards supply chains are going to have to increase the amount of product they have, and end users are going to change a little bit their procurement practices to increase their stocks. Yeah.
That happened post-COVID, right? And didn't last very long.
I'd say it lasted 2 years.
But my point wasn't that 2 years wasn't a long time. It was more of they reverted back to the just-in-time model once things stabilized.
That is a good point. I do agree with that. But you know what? Even though they reverted back to the just-in-time model, 2.5 months ago, prices were low enough that I think there were people trying to rebuild their stocks because they felt that prices were low enough to do that. I don't know if they actually succeeded. My gut, based on what we're hearing from customers right now, is they didn't. But there was certainly a willingness to build back inventory levels if the price was right.
Yeah.
In the meantime, we're dealing with disrupted trade flows. And so my second question for you guys is, we talk about disrupted trade flows, but let's put some examples under that so our listeners understand what we're talking about. How will these trade lanes shift? Where will product flows change? Will we see maybe more U.S. product going into Southeast Asia, more European product going into the Middle East because perhaps they can put it on a truck and ship it through Istanbul by rail or by truck all the way there? I don't know.
Yeah, I think that's a super good point. And it goes into what Diego said, which I don't think is limited to non-fat, by the way, or milk powders. I think customers need to buy and are used to getting what they need quite easily. And they've run their structural days in inventory down quite a bit to where that's going to require people to buy from where they can get it quickly. This disruption is served as a bit of a catalyst to something I think was already materializing or happening. And now if you inflate freight rates a little bit more, that's only going to make it that much more pronounced that you need to buy from who's close. New Zealand's having a good back shoulder of their season too. And I believe that there's quite a bit of New Zealand product that is on its way or destined to go to the Middle East and North Africa. So when we think about what happens, I think everyone goes back to their closest trade partner that takes the Oceania product to Asia. It takes the US product, obviously, to Mexico. There's at least some risk that European product was going to come to Mexico. This is making that more difficult, I imagine, as well. And I guess they're going to have to problem solve if that demand holds under the scenario we talked about earlier, that Europe's got a lot of product right now. There's a lot of milk and they're making a lot of everything. And thus far, it's been okay because exports have been reported to be good. Maybe we're talking about how this impacts the Americans, but I imagine that the impact might be a little bit more extreme for the Europeans. There's another impact in there that I think Diego touched on. When you have commitments for product and that product takes longer to get to you and you're running your supply chain thin, you reach out then and buy other product at a higher price often to fill your immediate demand. And once everything stabilizes, you actually are structurally oversupplied. We experienced that within recent history.
Oh, absolutely.
And so that creates that air pocket in demand that will eventually arrive. We just don't know when.
What I imagine is those boats that are on the water that were heading to Daman when all this started, they're either parked right now, waiting to see if everything clears up, or they're getting themselves rescheduled into Jeddah to try and figure out how to get there another way. I would assume the product that hadn't been loaded onto a ship yet is backing up at the port for a little while. How long do you think it takes? How long do we need to be watching this conflict continue to go on, watching the Strait of Hormuz continue to be closed? How long will it take before do you think they'll start selling that product elsewhere, canceling contracts and selling it elsewhere? A month, 2 months? Because my gut tells me that that's when you really start seeing the market shift around. Right now, everybody's just in a waiting period. Right now, everybody's just wondering if this thing's going to last a long time or a short time, and they don't want to overreact just for everything to clear up in the next week or two, even if the possibility is low.
Non-fat futures are inverted, so I would imagine not very long at all. But I don't think non-fat's the most impacted product here.
The curve on the butter futures is really flattened out as well. There's not a long time window there either if we don't put a decent carry back in the market.
So the market is already pricing in the possibility of this going on a long time, but the cash markets haven't really fallen yet because there's still hope. Maybe that's a good way to put it.
It's only been a week, one business week. That's a big conclusion that our team had earlier today, is that we came in Monday following the announcement and we're like, okay, what happened to dairy? And the reality is everyone's trying to figure it out and it's going to take some time. So I don't think we've seen the reaction or response to the situation actually materialize yet.
Do you think that the question everybody should be asking is, how long is it going to take for the Strait of Hormuz to open?
That's a big caveat in this whole situation, right? Once that opens and trade flows resume, that clears a lot of things up. Regardless, it's going to take time to clear up, right? Because you're going to have backlog. But the sooner that reopens, the sooner things pseudo will get back to normal.
So much energy flows out to that strait, to the rest of the world, particularly to Asia, that it can affect incomes, affect ability to purchase products as well. It isn't just bringing things in, it's how they get the oil out. Question for Diego. Iran certainly makes some SMP. Do you think that has any impact at all?
That's a really good point you're bringing up, Mike. Iran had, for the past 5 years, ramped up their SMP exports significantly. So I believe, if I'm not wrong, 2025, they exported something like 120,000 metric tons of skim milk powder. It's obviously not one of the biggest exporters in the world, but it's a significant exporter. The most important takeaway is that they would supply those markets that are being affected by these interruptions the most. It's not only that region has fewer access to European and American and even New Zealand sources, but also one of their main providers has an active block on food exports as of right now. Both things tell me it's going to be harder for demand to get access to the product. If it extends this issue in time, this is definitely going to kill demand.
Let's talk this through. The longer this goes on, what are the countries that are really going to start seeing drops in demand because the revenue is dropping? Obviously, Iran. I think you got to include Iraq, Saudi Arabia, Kuwait, UAE. I think China too, because they don't have the access to energy. And maybe some of the other major importers of Middle East oil. Now, some of it will switch, probably go out of Jeddah, but I don't think there's a lot of oil exports leaving Jeddah. I think it's all in the Gulf.
What does it do for European product, though, given the fact that this is going to cause a spike in natural gas pricing? This is going to cause a spike in all energy pricing. When the whole Ukraine situation escalated and Europe lost access to gas, it would cost something like $500 per metric ton just to dry the product because of the increased cost of gas. That put a lot of pressure onto the skim milk concentrate, and it gave a lot of support to skim milk powder. I think something similar is going to happen in the coming weeks, because we all heard the news about, if I'm not wrong, it was Qatar that just shut down the world's biggest LNG plant. And it takes, I believe it's 40 days for it to be back online at full operations. It's not a 1 or 2 day interruption. It's a substantial interruption in the energy supply at a worldwide level.
You know, the one big difference between when we've seen gas prices spike in the past and this time is, in the past, when energy prices spiked, demand in the Middle East would actually go up, because they'd have more revenue and more income. They don't this time around because it's spiking because they can't be the exporters and make those sales. I think that's important to take into account. You've got a scenario where if this goes on long enough, I think there's some real negative effects on demand that we've got to start coming to terms with. I don't think that matters if everything opens up within the next 2 to 4 weeks. We'll see if that happens.
Generally, this administration is responding to economic pressure. We see what's happening in the stock market, and we see what's happening with energy costs. They're going to be rethinking hard on how long they want this thing to stretch out, regardless of what maybe some of our partners would like it to be. There's going to be some strong economic pressure internally. Even the Senate, who voted to support continuing the fighting in Iran, did say, we're good for now, but revisit this if we need to.
That pressure by the day is going to keep going up. I'm 100% in agreement with you, Mike. And that's why my hunch is you're not going to see the Strait shut down for an extended period of time. But we don't know. We'll have to wait and see. Hey, thanks, guys. That was a great discussion today. It remains to be seen how this plays out. This is something that absolutely bears watching, because it clearly is going to have some effect on dairy demand. We will see.
We welcome your participation in the Milk Check. If you have comments to share or questions you want answered, send an email to podcast@jacoby.com. Our theme music is composed and performed by Phil Kagi. The Milk Check is a production of TC Jacoby and Company.